Welcome to the Property Proficiency Workshop. Whether you're just getting started in property or you've been established for many years with a large portfolio, this is the place to be. The place to turn your assets into financial freedom, accomplish your goals, live a better life and leave a lasting legacy. I'm Shaz Nawaz and I've been teaching others my strategies for over 18 years. This is the first in a series of 3 training videos in this workshop where I'll be teaching you how you can achieve financial freedom through property investing and accomplish your goals. I didn't always know how to get started in property and made loads of mistakes which I could have avoided, and as such I ended up making a lot of mistakes. One even cost me £329,000. When I first started doing this, I had no help from anybody and I risked all my own money. I aspired to have my own property business that would give me the financial independence I wanted. Now I deal in millions and I teach others how to avoid those same mistakes, so they can set up the right structure, choose the right strategies that will help them succeed and find the best deals and the best investment partners. I'll show you shortly how I discovered the answer. The goal of this workshop is to show you the critical things you need to know to attain total financial independence by building a thriving property business, while avoiding the common and very costly pitfalls along the way. When you have the knowledge, find the opportunities and get the right support, then you can finally start making the time and the money to enjoy the things that matter to you. So let's dig in. In this first video, we're going to focus on the business structure. I've even produced a helpful guide which you can follow and download in the description below. Welcome to the first lesson of the Property Proficiency Workshop. The first thing that you ought to know is before you start your business, you have to get the business structure right. That's the foundation of any good and great business. And when you're thinking about the structure, there's 3 important questions you must answer. The first, is it legal? The second, is it effective? And the third one is it acceptable to you and to HMRC? If you can't confidently answer yes to all of the 3 above, then stop and rethink before you go any further. Before we look at the 4 main business structures, you need to ensure that you're considering the most important factors so you get it right in the first go. There are 6 things to think about when deciding on the best business structure for yourself: liability, tax, accountancy costs, statutory regulations, ease of management, and bringing in other parties. I will cover all of these for you when we look at the different business structures next. You should think about what will be the most effective, efficient, and manageable structure for your business. Let's first explore a sole trader business. Now you must be aware that you are fully and personally liable for the business costs and its debts. You include the business profits as part of your annual income for personal tax purposes, and you pay the tax based on the income that you've earned, not just from your sole trader business, but all your income for that particular taxable year. For example, if you earn £50,000 from your business and you earn £30,000 as an employee, when you do your tax return, you work out the tax on the £80,000 that you've earned in the year. You then take off the tax that you already paid as PAYE, pay as you earn, for your £30,000 salaried income, and then pay the balance, which is the tax on the £50,000 from your sole trader business. If you stop trading or you sell your business, then you can sell your assets or you can sell your goodwill, and you pay 10% tax on the proceeds if you can claim business asset disposal relief, and that gives you up to £1 million worth of lifetime allowance. If you've already used that, then you would pay 20% tax on the proceeds. Your accountant prepares your accounts but you choose to file your own tax return, or your accountant can file it for you, and it's filed by the 31st of January in the following year. Most sole traders have their accountants file their tax return because obviously they've done the accounts, they understand your situation, your circumstances, so it's easier and better for them to file your returns for you and tell you how much tax you need to pay. The second form is a partnership. So you and your partner or partners are liable for all the business and its debts. You or your accountant would file the partnership tax return every single year for when the business is trading. The partnership itself doesn't pay any tax as an entity. Its members or partners pay tax individually, and of course they maybe have other income, so they pay tax on all the income for the year, including their share of the profits from the partnership. Each partner submits their personal tax return and pays the tax based on their total profits and income in that year for everything that they've earned, less any tax that they've paid elsewhere through pay as you earn or through other means. For example, if your business makes £200,000 profit and your share is 25%, then you pay tax on the £50,000 partnership income, and if you've got other income, just as the example with the sole trader, you'd add that together, work out the total tax, take off any tax you've paid on the other income, and then pay the balance by 31st of January. The management of the business depends on the partnership agreement, and it's important you have that in place. As I've said, a partnership agreement is crucial in running a smooth business, and it's going to help you gain clarity, avoid issues, challenges, problems, confrontation with your partners. So please make sure you have one in place, and if you don't, go and see a good commercial lawyer and they'll help you draft one which is bespoke to your and your business needs. Now you can bring in other partners into your business, and that depends on your partnership agreement and how it's structured, so make sure this is covered in the agreement. Also cover how you would resolve disputes, because inevitably they do happen when you've got 2 or more people involved. Clarify roles and responsibilities so everybody knows what they're doing. Have a clear clause in there what happens if somebody wants to retire, or what happens if the other partners want to show one person or a number of people the exit door. If you neglect the things I've just shared with you, amongst many other things, it's going to be expensive, it's going to lead in legal fees, and that costs a bomb, and you may end up at arbitration or at court, and that's going to be even more costly. Your third option is a limited liability partnership, and I like these because I think they're underused, but they work exceptionally well. So they work the same way as the partnership, but you are not personally liable for any of the debts of the business, because the partnership has limited liability, and the clue is in the name. Now, this structure is very popular for people in property, but not everybody knows how to use it. So if you're going to use an accountant, make sure you choose one who knows and understands how a limited liability partnership works. You or your accountant would file the LLP partnership return every single year. The partnership itself does not pay any tax, just like a normal partnership, but its members do. So in a normal partnership, you're called partners. In an LLP, you're called members. Each partner or member submits their own personal tax return, and as the earlier 2 examples with a sole trader and a partnership, they pay their tax based on their overall income for the year. As with the partnership, make sure you have a limited liability partnership agreement in place. The fourth and final, and the one that's pretty well known, is a limited company. With a company, you are not personally liable for any of the debts, because the company is a separate legal entity with its own persona. However, if you've given a personal guarantee when you've taken out a loan, a mortgage, or something else, then you do become liable for that amount of debt. So let's say you've taken a mortgage for £300,000 and you've given a personal guarantee for £100,000 of the £300,000. If you can't pay the debts and the company has to go bust, whichever company gave you the mortgage, i.e. the mortgagee or the lender, will pursue you for the first £100,000 because that's the amount you guaranteed. So please bear that in mind when you're signing personal guarantees, because all too often I've seen people get excited, sign personal guarantees, forget about them, something goes wrong, the lender comes back and says, you signed a personal guarantee here, can I have the funds? And the person who signed it has no recollection they'd signed the guarantee. So guarantees are very important. You need to understand the consequences, and if they can be avoided, avoid them. But knowing everything I do over the last 18 years, they can't always be avoided, but go into the arrangement with your eyes open. Unlike a partnership or an LLP, a limited company pays its own tax because it has its own tax reference number. Your accountant or you will file the corporation tax return, and then the company would pay its corporation tax. At the end of the year, the company pays the corporation tax based on how much profits you've made and based on the rate of corporation tax in that particular year. The accounts, generally speaking, are more complicated, so more often than not, most people use an accountant, and the accountant prepares the accounts using the information that you've given them and also in line with Companies Act and Companies Law. So therefore, because more work's involved, the fees are going to be higher for preparing limited company accounts. You'll also need to file returns with Companies House, so bear that in mind, and you have to follow certain statutory formats. Also bear in mind, your information is in the public domain, because when you open up a company with Companies House, there's certain information that Companies House make available to the public. So if confidentiality or secrecy are really important to you, then having an LLP or a limited company might not be the best option for you. The management style of the company depends on how the directors of the company want to run the company, and because ultimately it's their responsibility to manage the company. In a smaller company, the shareholders and the directors generally tend to be the same person or the same people, so it's hard to diverge and create a distinction between the responsibilities of both shareholders and directors. And this is why all too often when people take money out of a company and don't understand the tax consequences, and the accountant says you can't take that money out because you haven't paid tax on it, they say, well, why can't I? It's my company, I can do what I like. And I can assure you the accountant's right. You have to make sure you understand the consequences before you take money out or before you do anything in the company. And the more the company grows, the bigger it is, the more likely you are to dip your hands into the kitty to take money out to buy a new car, to buy a new house, to pay for school education for the kids, to go on a holiday, to pay off your mortgage. Therefore, you need to be more financially disciplined. The Articles of Association is a crucial document. Make sure you get that right, and make sure you work with an accountant who understands company law and who fully understands how a company works, including the Articles of Association. I'll emphasize the point again. It's better to use an accountant and their expertise to create bespoke articles, because all too often I see people going onto Companies House using the standard articles to keep it cheap basically, and they form a company and later on the articles aren't fit for purpose, and then they go to see a solicitor and it costs them between £1,000 to £2,000 to change the articles. Why not get it right in the first place? Now, bringing in other parties into the business depends on the Articles of Association, and that's why it's important and crucial you get that bit right. Now, you may be thinking, what happens when a company is formed? Well, first of all, once it's incorporated and registered, it shows up on Companies House. You have a company number. You then create a memorandum and Articles of Association. The company would choose an SIC code, which is your standard industry classification code, depending on the type of work and the type of business you're in. So for example, if you're in property, you could be renting property, You could be buying and selling property, you could be refurbing property, you could be an acting agent for a third party, you could be a deal sourcer, you could be a property developer, you could be doing serviced accommodation. All of these have different SIC codes, and you need to make sure you use the correct code. Again, a good accountant can guide you on this. Do you already know which business structure you want to use, but you aren't sure on the next steps or the pathway to take to gain financial freedom? One important reason why people hesitate to get started is that they simply don't have enough cash flow to grow their business. But did you know that you can increase your cash flow by tens of thousands of pounds every single year from tax savings alone? Look out for the next lesson, and in that workshop I'm going to be focusing on tax saving strategies. Now, one important reason why people hesitate to get started is that they simply don't have enough ready capital. But while you hesitate, the world keeps turning on, and while you're losing time, missing out on opportunities, and spending many more years staying where you are, did you know you can use other people's money? The buy, refurbish, refinance, rent, for example, really has been a game changer for many property investors. I really wish I'd known that when I first got started. But more on that later, and other investment strategies. In my next video, I'm going to show you how to get tax efficient and to make sure you get the investment capital you need to grow. But right now, I want to know a little more about you. What does financial freedom mean to you? What specifically is holding you back from attaining this? Please tell me in the comment section below in this video. And of course, if you like this video and you found it useful, I would love if you click the like button, subscribe to my channel, and hit the notification bell to ensure that you don't miss out on any of the videos going forward. And believe me, you do not want to miss out.